Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for June 6th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and a very special guest. We have Saritha Willingham joining us this morning. Good morning.
Good morning.
Good morning.
We discovered in the pre-show that Saritha is a UGA Bulldogs fan, and many longtime regulars will understand why that is a big deal coming on this podcast. And I know that Matt Clark, if he's listening, will be thrilled to know that he has some on-show support for his Bulldogs this morning.
Right.
Trucking and college football. Can you name a better combination? So, Saritha, do you mind ever giving everyone a quick intro of what you're up to and your background before we get too far into the show?
Absolutely. Thank you guys for having me today. My name is Saritha Willingham. I am the founder and CEO of SJW Logistics. We are a full-service 3PL. We offer freight transportation, warehousing, and order fulfillment services. And we have been in business for 6 years now.
Awesome. Well, we're thrilled to have you on the show.
Right.
We always try to get different perspectives, and I think this will be really cool to hear when we bring you back towards the end to talk about growing and scaling a smaller business, because I think that's something a lot of folks who listen are very interested in, and we don't get that perspective very often. So thank you for joining. We're going to move through some of our content so we can bring Saritha back quicker than normal. So we're going to say goodbye to Saritha for a minute here, and we're going to move into our key points of the week. So dry van and spot rates, maintaining ground, dry van and reefer spot rates for the third week. This is a really welcome sign. I think a lot of folks expected it to dip back down after road check. Not sure how much the West Coast port issues are playing into that or some of the weather conditions, but it's good to see regardless. Interstate capacity continues to decrease. When you add up May, I think we're over 15,000 net negative from where we were at the COVID peak. And that single month is the highest, second highest since January 14. That West Coast port closure is justifying shippers diverting freight. Again, it was, I think, number one or number two story this morning on all the morning news channels. So this is something I think to really keep an eye on. It could be one of those catalysts into a tighter market, or, it could just go away. Just something to keep in mind. California produce starting slow as Mexico is seeing volume surge. And then diesel prices on watch as Saudi Arabia cuts production. However, diesel did just fall, I believe, almost 6 cents a gallon this week. There's been some decoupling there, especially from gasoline with crude oil prices. So that's just something I think to keep in mind, especially as Dean notes here, heading into the start of hurricane and summer driving season. So with that, I will turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. Let's start off with the dry van load-to-truck ratio. Volumes predictably dropped last week following the short work week post-Memorial Day. Load post volumes down about 6% week over week, about a half what they were a year ago. So significantly less volume compared to the heady days of 2022. Equipment posts down 18% week over week. Load-to-truck ratio up slightly from 2.68 to 3.07. In the refrigerated market, volumes are down, impacted by lagging produce volumes. USDA data out last week says that weekly truckload volumes are down about 8% compared to this time last year. We've got some severe weather at the start of the year. That has really slowed things down in California, although they are recovering. A lot of the shortfall on the West Coast has been picked up by higher volumes across the Mexico border. Produce imports from Mexico are up 15% year over year last week. The caveat with all of the USDA data is that citrus gets reported quarterly in California, so we won't know what the California year-over-year numbers really look like until the early part of July. That gap could close. A load-to-truck ratio in refrigerated up slightly, 3.73 to 3.89 loads per truck. And in flatbed, volumes dropped last week, down 17% week over week, about 5 times lower than this time last year during the housing construction boom. Volumes are around half the average of week 22 in pre-pandemic years, almost identical this week to 2019. Equipment posts were down last week, resulting in the load-to-truck ratio remaining fairly flat at 12.71. Having a look at some of our markets, a bit of a focus in dry van and reefer this week along the southern border. Our market condition index, you can see lots of hotter temperatures across the southern border. Capacity was tight in dry van last week. Of course, Mexico is our top trading partner, has been that way since December last year. The number one crossing zone for commercial activity is the Port of Laredo. In that particular market, rates were flat last week at about $1.85. Remember, folks, these are line haul rates excluding the fuel surcharge. So outbound loads in Laredo at $1.85. They've been increasing for the prior 4 weeks. Laredo to Dallas at $2.53. That's the highest rates have been on that lane since last October, at about 20 cents a mile higher than last month. Having a look at the West Coast, in Ontario, California, rates increased by 7 cents a mile to $1.97 last week. That's the 4th week of gains in the Ontario warehouse market. Los Angeles outbound rates up 3 cents a mile to $1.84. Houston rates have been increasing for the last month, up 3 cents a mile to $1.71. One of the other lanes I look at on the East Coast is Atlanta and Chicago. Spot rates in those markets were up by 2 cents a mile to $1.88 and $1.94 respectively. So it's $1.88 outbound Atlanta and $1.94 outbound Chicago. In refrigerated, again, having a look along the entire southern border, the USDA reported a shortage of trucks in only a couple of markets last week. Nogales, Arizona was one of those markets. That's where 62% of Mexican watermelons come into the US. Capacity was fairly tight there for outbound reefer loads. That's in our Tucson market. On our market condition index, average spot rates were 247. Nogales to San Diego was at 275 last week, the highest in 12 months, and also 27 cents a mile higher than last month. Nogales to Ontario at 261 per mile, also the highest in 12 months. Having a look at the San Francisco outbound market, reefer rates were $2.16 per mile last week, up 2 cents. Loads from Salinas to Hunts Point, New York, also the highest in 12 months at $2.19. And according to Ratecast, they're forecast to peak at about $2.26 later this month. Capacity in Houston tightened last week, spot rates up 9 cents a mile to $2.04. Regional loads, 350 miles to the east of New Orleans, were flat at $3.36. Houston to Dallas, also the highest in 12 months at $7.90 per load, or about $3.28 per mile. And having a look at flatbed, volumes in key steel producing states, were boosted last week. Higher production volumes, up almost 2% year over year. In Gary, Indiana, the largest flatbed market for steel, outbound rates increased by 15 cents a mile to $2.76 after dropping for the prior 3 weeks. Gary, Indiana to Minneapolis, $2.92 per mile, up 12 cents compared to the last 2 months. $2.76 a mile. Regional loads from Gary to Cleveland are about 10 cents a mile higher than the previous month, while loads to Pittsburgh at $2.59 are the highest since last August. Capacity in the combined Little Rock, Memphis markets were tight last week. Rates up 16 cents a mile to $2.85. And our benchmark flatbed lane, one of our busiest lanes in flatbed, is Houston to Fort Worth. Rates at $2.98 per mile. Last week were flat. The Texas state average at $2.35. It's within about 12 cents a mile of where it was in 2018. And wrapping up our market update with our year-over-year look at spot rates, dry van line haul rates inched higher for the 3rd week, up almost a penny per mile. The 7-day national average ended the week just over $1.71 per mile. It's about 33 cents a mile lower than this time last year. And on our top 50 lanes, based on the volume of loads moved, they averaged $2.02 per mile last week, the first time they've been north of $2 for quite a few weeks. That's about 31 cents a mile higher than the national average. In refrigeration, line haul rates were flat for the 3rd week at a national average of $2.05. At that level, spot rates are about 11 cents a mile higher than in 2019 and about 33 cents a mile lower than this time last year. And wrapping up our market update with flatbed, and my screen has just vanished for a second there. Let me just quickly pull that up. Spot rates, that's embarrassing. Spot rates were at a national average of 221 last week, up by almost 3 cents a mile in flatbed. Spot rates have gained about 7 cents a mile in the last month, although they're still about 40 cents a mile lower than this time last year. So that's it for the market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published later this evening. With that, it's over to the short-term forecast, and Ken can take us through that.
Thank you very much, Dean. So as Dean mentioned, we're going to go into our short-term forecast right now. Really can kick up my heels and put on resort wear and maybe sip a pina colada because the short-term forecasts are pretty mundane, which is a good thing. So just to level set what we look at here, this is national spot dry van. The blue line is the historical 7-day weighted moving average. We take that all the way back to February for you to give you some sense of history. And then we've got 4 forecasts, I should say. Red is a short-term forecast. Green is ratecast. That's in all of our products, RFP tool, rate view, IQ, etc. And then you've got a gray and a yellow, which is intermediate blends in the middle there. And I think what you see is a lot of forecast agreement, which is harkening back to my pina colada comment. When these things are controversial, it tells us there's a lot of volatility and a lot of uncertainty in the market. And where there is a little bit of a gap between the high and low estimates here, the short-term forecast is a little more bullish, with ratecast being a little bit more bearish as it pertains to dry van, but all pretty much have a similar shape heading into the 4th of July peak. Now, again, remember, back in 18, that year and a half, 2-year run we saw pivoted almost to the day after the 4th of July holiday back into a down cycle. So the seasonal pressures come off pretty much instantaneously after the 4th. That's something just to keep in mind as we again look to tropical weather and any potential labor disputes. Let's get to refrigerated because it's even a tighter story. There's really no disagreement until the end of this month, and then you just start to see a little bit of a fanning out between the different forecasts. Nothing to be alarmed about, I would say. To me, it's a little surprising. I think it harkens back to the weak produce volumes that Dean mentioned earlier, but I would expect reefer to be a little bit stronger at this period in time, but it's not. And I think it's something to keep in mind as we build up there. A lot of reefer is much more seasonal, right? So a lot of these smaller carriers are banking a lot of profits. They're banking on a lot of profits, I should say, during this time of the year. And we, if we don't see that, that could be troublesome as we get into the slow time over the summer. Moving on to flatbed to round us out, almost perfect alignment between the forecast, maybe a penny or two of leveling difference as we continue to see demand for commercial multifamily warehousing. That's going to continue to buoy that. We visited with a flatbed carrier this past week, and heard a very similar story that corroborates a lot of this data that we are seeing. So that's always good to get out in the field and have those conversations. But with that, we made it through in record timing to bring our guest back because I think this is going to be a really good discussion that you all will be interested in. And I will turn it back to Dean for the question of the week.
Yeah, thanks, Ken. I first got to see Saritha on the Sales Chatter show with Ryan Muhammad and Jeff Dickinson and Dan Deegan some time ago, and I was suitably impressed. I thought it'd be great to get her perspective on what it's like for a small businessman or a small business person in this economy. So, Saritha, how do you scale a small business in this current economic climate?
Well, Dean, it is tough. Really great question. That's what we've been trying to figure out, all year long is how to scale. We've been like on a roller coaster ride. I can speak for a lot of small businesses because I talk to them and deal with them. A lot of our vendors are small businesses. And, it feels like sometimes we're reaching the peak of that roller coaster and then it just drops really fast there when we think things are leveling out. So the way to scale, honestly, in this economy, I feel you need time there for things to continue to balance out and work themselves out. I think there's a lot of post-pandemic balancing with a lot of retailers and manufacturers that they're trying to sort out. And then the other thing is I tell people never stop growing, just because we're in an economy that's not very favorable right now is to continue with your business plans on growing because sometimes, not often, but sometimes you can outgrow the debt that you may be occurring from this as a small business.
So, Saritha, sometimes, growth for growth's sake is not necessarily healthy because some things you can't scale in a business efficiently, particularly when it comes to the softest side of our business, the people side of our business. In my experience, whenever I've run a truck company and put on more trucks and drivers, I've just ended up with more headaches and more problems and more service failures. How do you cope with that part of the business?
Some things, what they say, you got to take with the territory comes with the territory. It all depends on what the goal is. I wouldn't advise anybody to scale up or try to add on more debt if they don't have potential customers or people they're working with. Like, make it balance out, supply and demand. Don't just do it because you're trying to throw something at a problem, right? You want to have make sure you're solving a solution there. Because you're right, when you add more trucks or add more drivers, it does come with more problems.
Right. But what you're saying, I guess, is that if you're growing in line with your customers and your customers' growth plans, then you can more tightly align all of those different aspects on your side.
Absolutely. And a lot of times we do have those monthly MBRs and quarterly QBRs with our customers because we want to be a reliable partner for them. Right. So we're always looking for new customers, Hey, let's see. We have to be able to change, be able to pivot really quick in times like that when you're going through, as a small business, when you're going through things.
Right. You've spent many, many years in the corporate world in Atlanta before starting your own business. What sort of things were you able to bring over from working for, Fortune 500 companies to your business that other smaller entrepreneurs could take on board and learn from?
I think the most valuable thing that I brought over from being in corporate America was business planning, being able to, manage by the numbers. That's really big in corporate America. They manage by the numbers. The numbers show this, the numbers show that. So I do the same thing. I have systems, unlike, that's what a lot of people tell us we're different at with small businesses. We invest in technology because I look at weekly numbers. I look at monthly numbers. I set goals for my team. On my operations side, hey, we need to hit this per day and this per week, regardless of things going on. So, that is the most valuable thing I have bought from corporate America is being able to do business planning and managing by the numbers.
Right.
I apologize. I'm not as chatty as normal. I'm dealing with some extreme Ohio allergies that have just kicked my butt. But as you look forward into the summer, what are you looking for in terms of events or metrics that you're tracking that'll give you indication that we're starting to round the corner into the next positive freight cycle?
I think the biggest thing I'm looking for is we depend on retailers. We depend on retailers to have sales, their customers to make purchases, because we deal with a lot of retailers from our warehousing to our trucking side. So what I'm looking for is I'm looking at the different sales that come up. For instance, you have Christmas in July, then you have your Labor Day sales, and then it goes into the holiday sales and the Black Friday sales. So if I can see in the retail market more spending and that trend going up, that will have it will have a trickle down effect on us where we'll be able to move more freight.
Right. So does that follow that the warehousing, logistics aspect of your business complements the asset side of your business more so than just an asset-based carrier?
Yes, it does complement that. It really went well during the pandemic because, people were over ordering product and storing it in warehouses to just in case there was another shutdown, they wouldn't be without product, right? So now we're in there and we've had some product in our warehouse for over a year. So that's all because of, the retail sales where they were selling. Now things have slowed down, but it does help complement things with our trucking side because we're able to offer all those services all on one invoice.
Was it inventory sitting for a year because it was the wrong inventory at the wrong time, or was it just literally a space issue?
It was, in my opinion, some of our customers just don't have enough diversity in their service offerings. Their people are still buying, but when you have I'll give an example. We have toy manufacturers that are having inventory. Well, toys is something that's kind of hard to sell year round unless it's a specific, toy or trend going on. So their biggest sale come during the holiday time. But however, they over ordered again because they felt of a shutdown because when they originally received their contract, COVID happened. So they didn't have the inventory to sell.
Right. I'm curious, you've got some assets, right? So you're clearly running trucks. Tell us a bit more about that. Are you doing sort of more regional work or local P&D final mile work, or is it sort of white glove liftgate type work?
So one thing I love about my team, we're flexible. We have 18 semi trucks. We do dry van, reefer, and flatbed. And we do have the Georgia people that do the containers, but that has fell off. But I felt every statistic that you gave in there about the rates. And, with our dry van and our flatbed, they're over the road. So we tell our team we have to be more flexible now. We can't be as comfortable and stay in the Southeast region, even though that's where we're based. We let them know you have to be flexible. You have to go in those states that you don't want to go into, to be able to get the better rates.
Right. One of the things a lot of our carrier customers talk about is it's hard to find experienced drivers. Some say it's just hard to find applicants, regardless of experience. What's your experience been in finding drivers in the last couple of years?
We actually have not had any problems finding experienced drivers. What we have had a problem with finding is realistic drivers, right? So everyone, not everyone, but a lot of drivers that probably came into the industry during the pandemic time, they have their mindset set on certain rates and certain income they were able to bring in. So when we speak with, because we lease on owner operators, investors, as well as we have our own company trucks. So when we speak with drivers, we're realistic. We ask them, what is their goal? What are you trying to take home each week? And if they tell us something, I'll give an example. We have drivers that'll call us and say, I want to be home every day. I want to be home on every weekend, and I want to take home $1,500 a week. And we just let them know we're not the right company for them, because if that was possible, everybody would do it, right?
Right.
Anything that's too good to be true is not true. But that is the biggest problem we're finding with hiring drivers, is managing expectations, because their expectations in this market is unrealistic a lot.
I think it's very insightful. Some of the most insightful things I've heard about drivers is realistic drivers, because that's always the problem, right? When you talk about recruiters and why drivers leave, it's always about misaligned expectations. Excellent feedback.
It's been fun. Usually when we have like pricing or analytics guests on here, Dean has to sit there and listen to me geek out with them. It's been really fun to watch you two geek out on the trucking side of things. I'm just sitting here and quietly taking notes and observing. I did have one question, Dean, if you don't mind, for Sarita, is we heard a lot about shifting volumes, not necessarily due to the amount of freight, but diminished fill rates and load factors and imbalances in and out of warehouses and distribution centers. Are you seeing that completely return to normal? Has there been any artifact or shadow of COVID that's shifted things from a long-term trend?
Yes, I can definitely see buying habits and customer inventory management and ordering habits that have shifted, because during COVID, we all, even down to businesses, learn how to manage and live with less, right? So we were able to see we need less clothes, or we don't need an office space, and different things like that. So with that, I see a lot of things that are just not, seem like they're not coming back, because people have managed to adapt to having less and working with less, but still able to provide a certain service level to their customers that is satisfactory.
That's interesting. I think the good thing is we're seeing these stock downs really take hold. I saw an infographic yesterday that a couple of the big retailers have already achieved the stock downs they were hoping to have by fall, which I think is indicative of probably stronger than expected consumer spending, which is good. Question just becomes, do things slow down over the summer?
I think things may slow down over the summer. We're seeing a lot of people get back out and travel more. So I think it's also going to depend on what market you're in when it comes to their spending and what they're seeing for their goals.
Yeah. It's funny, and I guess maybe there's like a way to end and move to questions from the audiences. It almost seems like the media really wants there to be a reset. And I'm not like one of those tinfoil hat media people, but like every headline I read, like yesterday, the headline on CNBC was, "Don't let strong consumer spending fool you. You can still have a recession in strong consumer spending." It's like every positive signal that we're getting is hedged against this overwhelming I don't know, entropy of a recession that's coming down the pike. And I think, that's if you ignore the fundamentals for too long, you kind of get lost in the sauce, I feel, of what's actually happening out there. Because
Yeah.
I don't know that it's as bad as people are painting it out to be.
And I'm with you on that. I don't think it's as bad as people are, as the media is making it out to be. There and if we keep saying we're in a recession, eventually people are going to believe it there. But if you think about it, they said the housing market was going to crash last year, and then just a couple weeks ago, JB Hunt's president said we're in a freight recession. With the way things are, and businesses are laying off people. Shopify had a really huge layoff, and they were really booming during the pandemic. So I think that, like I say, with the shift in spending, and there's still money out there for businesses. I just think it's been a shift. People go in different directions, and it's more so understanding the shift in the trend. And then I wish the media would sometimes educate people on what defines a recession.
Yeah. It was interesting, Sarita, the National Retail Federation came out today and said today's economy is looking a lot like a kaleidoscope. It depends on the direction you're looking as to what you're seeing. Lots of big signals. But the headline, to Ken's point, was economists say conditions look like a soft landing, not a recession. So even this morning, the biggest consumer organization is sort of painting that rather rosier picture. Questions,
I
Ken?
think let's move to questions. But just to pick at that a little bit, we could. I think the bigger fear here is not that we're going to like slip backwards into a short-term recession. I mean, to me, it's like, are we mortgaging our future, 2 to 3 years down the pike with, essentially like mortgaging inflation on debt, consumer debt, right? I think that's the problem that we can that's a discussion I'd rather have than like, is next quarter going to be this surprise recession? You know what I mean? Like, I know that story's already written and ready to hit send as soon as the data comes out, if it comes out. But I think the long-term implications more pertain to the fact that we could be mortgaging, a lot of this on debt, but maybe not. I mean, I think Sarita, you made a great point about the housing. We all expected with interest rates going up, housing to crash. We're seeing a major resurgence in new housing start permits, right? So it's a tricky. I'm glad I'm not in that business. Trucking's a little bit easier to predict than some of these recession type activities. But all right, let's get to some questions and then we'll wrap up.
Yeah, I got one for Tariq. I'm not sure. Sarita, you might like to have a crack at it, but its comment says, due to the rates, do you think as a logistics company it is beneficial to press towards your senators and the federal motor carrier to pass Super B trains in the lower 48 states? Super Bs are the Canadian B-double, 8-axle B-doubles or B trains, they call them up there. So increased weights and measures has never really gained traction here in the US, but longer vehicles seem to have always had opposition. Any thoughts on higher mass limits for vehicles?
No, I don't think it's a bad idea to bring things to the senators and FMCSA. But again, I always go back to, will that solve our current problem? What kind of solution does that bring there?
Well, based on my experience with road trains in Australia, it just means more weight and less revenue per mile. So it's a slippery slope.
These are the 33-foot pups, right, Dean?
Yeah, so the regulation is more than 28 foot, but they'll be typically 233s. Yeah.
I remember, again, I have PTSD from running the analytics when I was at FedEx. FedEx was a major proponent of the LTL division, Michael Ducker, of this legislation when it came really close to getting passed, 5 years ago at this point. I actually bought a lot of DAT data to help look at partials and the potential impact here, and it just didn't make it through. A lot of the big truckload carriers were against it, but a lot of local municipalities were against it too because of the damage on roads and the increased wear and tear. It's the same thing with triple pups, right? I mean, that's not legal in every single state. That's why you see some of the pull-offs.
Right. Next question, David Matheson. Long-term forecast, Ken, anytime soon?
Let's do it next week. Can you remind me, Dean?
Okay.
Actually, I don't know if I'll be on the show next week because I need to go to Denver. We're doing a big product planning session, but maybe the week after. In the next 2 weeks, we'll commit to having that on here, no doubt.
Got it. Okay.
I just ran it yesterday. If
Okay.
you reach out to askiq@dat.com, David will send you. I just ran it yesterday, so I can send you the drive-in one at least, and then we'll commit to having it on the show the next 2 weeks.
Got it. Hector Sanchez asks, people say DAT is not good for sprinter vans. We've had that question a lot over the last couple of years, Ken, during the pandemic in particular. What would you say to that, to someone that's interested in working with DAT that's clearly in that sprinter van box truck space?
We have a major initiative in place to add new equipment types. It's probably not going to come out for a little while, at least. We've got a lot of other stuff ahead of it in the queue. I would say short term, use the partial functionality and look at the pieces, dims, and weight, and see if you can get things that fit. It's no mystery that we're a predominantly full truckload and open deck resource. But I think there's ways you can still go in there, and there are people that successfully run freight in the smaller equipment types on our board just by narrowing in the pieces, dims, and weight to what might fit into it. It probably becomes like, I don't know that we have ways to delineate dock height versus. I've seen sprinter vans with lift gates; they're kind of hilarious to see them driving around. But if it's a dock high load and you don't know until you get there, you're going to have a pretty rough time, even if it's just a pallet. So.
All right. From This Little Life, great handle. What are you all doing to stop load posting, reposting of loads on load boards? Essentially the double broker question, Ken, that we've been getting.
Yeah, I would encourage you to report everything you see to compliance. We investigate every single complaint that we get. We have an outstanding compliance team. I'm checking in with them all the time. We're looking at new ways from a data science and analytics perspective to get out ahead of the curve on a lot of this. But my best recommendation to you would be to reach out to compliance when you see things with whatever level of specificity that you have, and they will investigate every single claim to completion. There's not a single one that goes uninvestigated on our end. So I would encourage you to reach out to our compliance team, and it sounds like you are already, so that's good.
Yep. Last question, pretty easy one, I think, Ken. When will the rate be back to normal from Yapeth Ted? I guess we could talk about drive.
We can all chime in on that one. I think we are trending shockingly close to what we've been saying for a while, which is this, that we're probably going to tip year-over-year positive sometime in the next couple of quarters. I don't think we'll see meaningful recovery, though, until next year. It looks like it's going to be a bit of a throwaway year in terms of rates. Now, there's a lot of people that are able to make a lot of money even though rates are holding water. So I don't mean that as a throwaway business year. I just don't know that rates are going to be the story again until now. That could be wrong, right? I mean, there's a lot more reasons for the rates to go up than there are for them to go down at the moment, whether that's the Teamsters and UPS, whether that's West Coast ports, whether that's tropical weather. There's a lot of things that could keep rates elevated. A strong retail shipping season, as Saritha mentioned, I think would be really, really good for the trucking economy. But long and short of it is, I would expect a pretty 2019-esque year and then full-fledged recovery this time next year. But
Saritha will give you the last word on that one. Your forecasting for the rest of the year.
My question to answer that probably would be playing devil's advocate a little bit. Like, well, what do you consider a normal rate? Because everybody has a different definition of what a normal rate is, even though we have the analytics here, right?
Very
So, I honestly, I don't feel like we'll see stable. I call them stabilized rates probably until 2024. I think the economy is going through I call it the balancing out after the post-COVID balance.
Right.
All right. Dean, plugs?
Yep. Just quickly, sales chat is on tomorrow, as is every Wednesday, 11 a.m. Eastern. It's Day-to-Day Wednesday. I'll be on with Ryan Muhammad, Jeff Dickinson, and Dan Deegan. We're on Landline Now tomorrow at 7 p.m. I'll be on with Jimmy Mack on Radio Nemo. Both those shows are on Sirius XM, Channel 146, Road Dog Radio. This week, we're talking about the 100 Deadly Days of Summer on Thursday. And of course, out last week on Freightvine was the episode featuring Corey Johnson, VP of North American Product Supply at Procter & Gamble. Great story talking about multidimensional logistics at Procter & Gamble.
Saritha, how can folks get a hold of you and your firm if they have freight that needs moved or they want to drive for y'all, or how can they get in touch with you?
Thanks for asking. You can actually find us at sjwlogistics.com on our webpage. I'm also on LinkedIn under Sarita Willingham. We also have a business page on LinkedIn, SJW Logistics. We're on all the social media platforms under SJW Logistics for Facebook and Instagram.
Fantastic.
Awesome. So like I said, I might not be around next week. I got to check and see when I'm actually in the air. I'll be flying to Denver. But we hope. Who do we have on next week? I know you said it, Dean, just to refresh my memory. I kind of spaced out for a second.
Oh, I knew you were going to ask me that. Let me quickly pull it up.
Maybe you didn't say it.
No, I did.
I still have baby brain. I'm still in the baby brain mode.
Guest list. No, it's not. I haven't got it. I know it's. I can tell you right now. If you give me 1 second.
7-Eleven is Stephen Linton. It sounds like.
No. It's Grace.
Oh, that's
Grace Ma. Grace Ma from OTR Solutions.
Oh,
our factory
yes.
Partner. Yes.
I'm bummed if I have to miss that, but I'll definitely watch it from the plane. She's terrific.
Yeah.
So that should be a really good call.
Yeah.
We've got some great guests lined up, present company included. So,
I
hope everyone has a great week. And if you're in the middle part of the country, I hope you enjoy this weather that we've been having. Stay safe, and we'll see you next Tuesday at 10 a.m. Eastern. Bye, everyone.